Hello everybody, once again on behalf of DM tutorial, I welcome all of you to this episode of my tutorial videos. Today's episode is based on cost and management accounting and the topic is marginal costing. In my previous video on the topic classification of costs under cost and management accounting, I have shown how costs are divided, classified, categorized for the purpose of cost control, cost reduction, valuation of inventory and pricing, and also to value the total revenue, that is the total income. So costs are primarily and fundamentally divided between prime cost and overhead costs or overheads. Prime cost consists of direct material cost, direct labor cost or direct wages and direct expenses. Sorry. And the overhead costs can be classified in three different ways. One, according to functionality, that is the function for which the overhead cost has been incurred. Another is according to element, that means the element wise division of overhead cost. And the third one is according to variability, that means how the overhead costs behave with changes in output. Now, prime cost or variable cost or direct cost is the cost that directly varies with output. Prime cost can be divided into three categories: direct material cost, direct labor cost or direct wages, and direct expenses. Direct material cost is the cost of material that directly varies with output. That means more the production, more is the direct material cost. For zero production, zero is the direct material cost. Similarly, direct labor cost or direct wages means the wages of those workers who are being paid on piece rate system of payment. And direct wages also vary directly with output. More the output, more the direct wages. Zero output means zero direct wages. And direct expense means the expense which is neither direct material nor direct material but is directly variable with output. Now, examples of direct expenses are not very common and are mostly observed in construction companies. For example, the cost of drawing and designing a project is neither direct material cost nor direct labor cost, but this varies with the output because in such business the whole project is considered as one unit. So these three costs make prime cost, and overhead costs are classified according to functionality, according to variability and element wise. Functionality wise, overhead costs are divided into manufacturing overhead or production overhead or factory overhead. Number two, administrative overhead or office overhead. And number three, selling and distribution overhead. That is the purpose for which overhead expenses are incurred. So under manufacturing overhead, a number of costs can be exemplified like factory rent, factory electricity, factory manager's salary, factory worker's salary, depreciation of machinery, lease, if any asset is taken on lease, etc. So all the expenses, all the indirect expenses, those are incurred in the factory are called factory overhead or manufacturing overhead or production overhead. On the other hand, all the expenses incurred for running the business, for administering the business, that is, all the expenses incurred in the office are called office overhead or administrative overhead or general overhead. Like salary of the office manager, director's salary, salary of the office staff, rent of the office building, etc. etc. So these expenses are incurred for administering the business. And the third function is selling and distributing. So all the expenses related to selling and distributing the product are called selling and overhead. Okay? And element wise, overheads can be classified as indirect material cost, indirect wages and indirect expenses. Okay? Now, today's video is primarily based on variable costing or marginal costing. First of all, we need to know what variable cost or marginal cost or direct cost means. Variable cost or marginal cost or direct cost means the cost that directly varies with output. So, when the output is zero, the variable cost is zero. Now, marginal costing or variable costing is a method of costing for valuation of inventory and cost of production and cost of goods sold. There is another way of valuing inventory and cost of goods sold, and that is known as absorption costing. But today's video is primarily based on marginal costing, not overhead costing. That will be taken care of in some other video. Now, in marginal costing, only the prime costs and the variable part of factory overhead are included in the inventory, cost of inventory and cost of goods sold. And all other overhead expenses, that is administrative overhead expenses and selling and distribution overhead expenses, are charged to the income statement as expenditure. So factory overhead, both variable and fixed, are included in the cost of inventory and cost of production and cost of goods sold. Now, there is a little difference between cost of goods sold and cost of sales, because to arrive at cost of sales, the finished stock has to be deducted and then the selling and distribution overhead has to be added. Now, under marginal costing, only the prime cost and the variable overheads are included in the valuation, and other expenses are charged as annual expense. Now, marginal costing has a number of purposes. Number one, for valuing the price, for valuing the cost of goods sold, for valuing the price of the commodity, for making decisions, that is for making management decisions. Now, decisions may include such situations when the management is confronted with a decision to either launch a new product requiring new machinery, so new investment, or the management can decide on ceasing producing a certain product that giving the company less profit and increase the production of that product which gives the company more profit. And in such cases where the management can choose whether to outsource the production of a spare part which is needed for the company's product, finished product. So there are many management decisions that can be taken by using the technique of marginal costing. Okay, now I will request you to look at my hard copy. I am writing here something for your benefit. If you concentrate on my lecture and if you go through what I am writing on my paper and follow that carefully, I can assure you cost and management accounting will be fun for you and you'll be able to come out with flying colors in your exams. Now please look at this. If we prepare a cost sheet, number one comes prime cost, then factory, under this comes direct material, direct labor and direct wages, and if we add these we come to manufacturing overhead. And after that we arrive at factory cost of production. This is factory cost of production. Okay, and this cost is used to value the inventory and the value of cost of goods sold. This is the system of valuation under marginal costing. And the rest of the expenses, that is all the overheads are charged to the income statement. On the other hand, after this point, overhead expenses are apportioned to the units according to some suitable basis. I will come to that in some other video. Okay, now let's see how this marginal costing technique or variable costing technique, it is more commonly and logically known as marginal costing, because direct costing is not a suitable word, because the word direct emphasizes on traceability, but marginal or variable emphasizes on variability. Variability with what? Variability with output. And of course it is very logical, since everything depends upon ultimately how much the firm is producing. So once again I will request you to listen to my lecture. To make marginal costing as an analytic tool, we use certain equations. What are the equations? When the variable cost or the marginal cost or the prime cost are deducted from sales, we get contribution. So sales minus variable cost is the contribution. Contribution to what? Contribution to the fixed cost and to the profit. So contribution is summation of variable cost and sale is the summation of variable cost and contribution. Now this contribution is used to recover the very fixed cost and to make profit for the investor. So sales minus variable cost is contribution. Since sales, the revenue of the company also depends upon the amount of goods sold, and variable cost also depends on the amount of goods sold. So we can find out the sales price per unit and variable cost per unit. So we can find out the contribution per unit, that is sales price per unit minus variable cost per unit is equal to contribution per unit. Now sorry, let me have some water, just few seconds. Now, if you multiply this contribution per unit by the number of units sold, then we get total contribution. This total contribution is used to recover the fixed cost. As you know, fixed cost is an annual expense. It is a function of time. It is not function of output. Fixed cost does not vary with changes in output. If the output is zero, still the firm has to pay the fixed cost, as those are predetermined and contractual costs. The producer has to pay even if the output is zero. That is, the rent of the factory or rent of the office have to be paid by the entrepreneur even if he or she does not produce anything. So there is the annual fixed cost that is fixed. And remember, fixed cost per unit comes down as output increases. As the same amount of money is being divided by more and more units, so fixed cost per unit comes down. Whereas variable cost per unit remains fixed. Remember, variable cost per unit remains fixed and it directly varies in total with the production. Okay? So sales minus variable cost is the contribution. Contribution minus fixed cost is profit. Sales minus variable cost is contribution, and contribution minus fixed cost is profit. Now, once again, please look at my hard copy. This is marginal costing. We are analyzing this as a tool or technique to take management decisions. So sales minus VC means variable cost, or marginal MC, marginal cost, gives us what? Gives us contribution. Contribution minus FC means fixed cost, gives us what? Gives us profit. Now, for marginal costing, there are certain terms. For example, profit volume ratio. Profit volume ratio, or commonly known as PV ratio. PV ratio. What is PV ratio? PV ratio is equal to contribution by sales, and contribution by sales, that is PV ratio, is expressed as percentage. So contribution by sales into 100. Now sales is made of contribution and variable cost. So the counterpart of PV ratio is the ratio of variable cost to sales. Okay. Next is break even point. Now this is very important to understand what is break even point. Break even point is the point where the producer is neither earning any profit nor incurring any loss. The producer is neither earning any profit nor incurring any loss. That means the revenue earned by the producer is only sufficient to meet the expenses without leaving anything for profit. Okay. Now break-even point has two concepts. Once again, please listen to my lecture carefully instead of looking at my hard copy. So break-even point means the point where the producer is at break-even. That means he is neither making any profit nor making any loss. Now, how the break-even point can be calculated? Now, break-even point has two concepts. One is the number of units that the producer has to produce to reach break-even. That means that many units is a must to only recover the costs. This is called break-even point in units. Once again, please look at my hard copy. Number one is BEP in terms of units. Now, how BEP in terms of units can be derived? BEP units is equal to fixed cost by contribution per unit. Break-even units is fixed cost divided by contribution per unit. Now you see, when we are talking about break-even point, we are considering that there is no profit. There is no profit, and contribution is the addition of fixed cost and profit. So we can say fixed cost plus 0 by contribution per unit. Now fixed cost plus profit, which happens to be 0 since the producer is in break-even. This is the total contribution. This ultimately is total contribution. In total contribution, the profit is 0, so fixed cost is equal to total contribution. So when total contribution is divided by contribution per unit, we get the break-even number of units. Break-even number of units. Okay, so BEP in units is derived by dividing fixed cost by contribution per unit. The another idea is break-even in terms of sales or revenue. That means how much the producer must earn as revenue to recover only the expenses without leaving anything for profit. So next one is BEP sales. BEP sales is derived by dividing fixed cost by PV ratio. That is equal to fixed cost divided by contribution by sales. Fixed cost divided by contribution by sales gives us break-even point in terms of sales. On the other hand, you can also find out BEP sales by simply multiplying break-even units by the sales price. So break-even units into sales price per unit unit is equal to BEP in terms of sales. Okay, so BEP has two parts. One is break even in terms of units, that is found out by dividing fixed cost by contribution per unit, and the other part is BEP in terms of sales, which is calculated by dividing fixed cost by PV ratio. And what is PV ratio? PV ratio equals to contribution by sales. So fixed cost divided by contribution by sales equals to the break-even unit, break-even sales, that is equal to break-even units into sales price per unit. Okay. Now I will draw a break-even chart, which is the exact tool for taking management decisions. Please look at this break-even chart. It is also called break-even graph. You must keep in mind that all the graphs drawn by me are not drawn up to scale. Okay. On the x-axis, we measure units of output. And on the y-axis, we measure variable cost and fixed cost is equal to total cost. Okay. Now, variable cost or marginal cost or prime cost or direct cost varies directly with output, and when output is zero, variable cost is also zero. So variable cost line starts from the origin and it is an upward sloping straight line if we consider the variable cost per unit remains fixed. And for simplicity, we are considering that. So this is variable cost starting from the origin, rising upward from left to right. This is variable cost. Now, the producer has to pay a fixed cost irrespective of output. So, a fixed cost line starts from a positive intercept of y-axis. That is, even when there is no output, the producer has to pay the contractual fixed cost, and whatever be the output, the entrepreneur has or the producer has to pay that until there are some changes due to time in contracts regarding rent, insurance premium, etc., etc. So the fixed cost line is straight line starting from positive intercept of y-axis and is parallel to x-axis. Say this is FC. Now, if we add fixed cost with variable cost, we get total cost curve. Remember, this length is equal to this length. Once again, I am telling you the graphs are not drawn up to scale. So this is fixed cost, this is variable cost, and this is total cost. FC equals to fixed cost, VC equals to variable cost, and TC equals to total cost. These three make prime cost. Sorry. These two make total cost. Okay. Now, if we draw the sales line also starts from origin, because if the producer does not sell anything, his income is zero. So if we consider the sales price per unit is fixed, then the sales line will start from the origin. That means zero sales for zero revenue for zero sales, and as the sales increases, the revenue of the producer increases directly with the volume of sales. Okay, so the sales line must start from origin and will be an upward straight line intersecting the total cost line. So let us suppose the firm's total cost line is this. This is total cost. This is sales line. This is total cost. This is variable cost, and this is fixed cost. Now you can see the sales line. The sales line has intersected the total cost line at this point. This is a point of intersection between sales line and total cost line. This is called the break-even point. At this point, the producer is neither earning any profit nor incurring any loss. Say this is Q. That means the producer has to sell OQ units to break even, to reach at break even point. If he sells anything less than OQ units, he will incur loss. If he want to earn profit, he has to sell more of the quantity. Okay, so this right side of this break even point, this is called profit zone. This is called profit zone. More the producer sales, more is the amount of profit. You see the gap between these two lines becomes bigger and bigger as the producer goes on selling more and more output. On the other hand, the left side of break-even point is known as loss zone. This is loss zone. This is loss zone. So if the producer sells anything less than Q, he starts incurring loss, and as his sales goes on falling, that is, he goes in this way, the loss increases. You can see the gap between these two lines. This is the total cost line and this is sales line, becomes bigger and bigger. On the right of this point, the total sales line remains above the total cost line, and at the left of break-even point, the total cost line lies above the total sales line. You can see this. Okay, now these angles, you know, geometrically these are opposite angles. Opposite angles of two straight lines are always same. Now these angles are called angle of incidence. This is called angle of incidence. This is called the angle. This angle is called angle of incidence. Angle of incidence. Now you can see, more the angle of incidence, more is the gap between sales line and cost line. That means more the angle of incidence, more is the profit per unit for the producer, because sales minus total cost is profit. If we divide this total profit by the number of units, we get profit per unit. So if this angle is bigger, this means the producer is getting more profit per unit, and that the company's profit earning capacity is relatively greater than other companies. If the other companies have lesser angle of incidence, I think you can understand what I am saying. And the next concept in the marginal costing tool is margin of safety. This is margin of safety. What margin of safety means? Margin of safety means the difference between actual sales and break-even sales. The difference between actual sales and break-even sales is known as margin of safety. So margin of safety equals to actual sales minus break-even sales. Margin of safety is equals to actual sales minus break-even sales. Once again, please look at this figure. Suppose the producer is currently selling. Suppose the producer is currently selling, say, S units of output. S. Okay. Sorry. S units of output. And what is his break-even units of output? That is OQ. We have seen it. So QS is the margin of safety. That is OS minus OQ is margin of safety in terms of quantity of output. That is actual sales is OS and break-even sales is OQ. The difference between actual sales and break-even sales is the margin of safety in terms of units. That is QS. And what is the margin of safety in terms of sales? You see, this is the amount of sales the company is earning by actually selling AC units. Say this is M. And at break-even, what was the sales of the producer? This was the sales of the producer. Say this is N. So OM is the actual revenue of the producer and ON is the revenue at break-even. So MN is the margin of safety. MN is the difference and MN is the margin of safety in terms of sales. Okay. On the other hand, margin of safety can also be calculated. Margin of safety can also be calculated. Margin of safety can also be calculated as profit divided by PV ratio. Sorry. Profit by PV ratio. This is another way of calculating margin of safety. In exams, you can directly use this formula, profit by PV ratio. Okay. Now you see how the profit can be seen by a break-even graph. Once again, please look at my hard copy. This is 0, this is x-axis, this is y-axis. Here we measure units of output and here we measure costs and revenue, that is income or sales. So this is the fixed cost line, FC. This is variable cost, this is total cost, this is VC, this is TC, and this is sales line. This is our break-even point. Okay. And suppose actual sales is OS as we have seen in our previous diagram. We are continuing with this example. Suppose the actual sales is OS. OS is the actual sales. Now, once again, look at the formula, that is sales minus variable cost equals to contribution and contribution minus fixed cost equals to profit. We have just learned sales minus variable cost equal to contribution. Contribution minus fixed cost equals to profit. Okay. Now look at this diagram. This is sales. This much is sales. Say this is point S. No, point S is already used. Say let it be point V. Let it be point V. Let it be point V, okay? Let it be point M. Let it be point N. So, SV is total sales and Sn is the variable cost, because this is variable cost line. So Sn is the variable cost and Sv is the total sales. So OSV minus Sn is equal to this much. If we deduct if we deduct Sn, that is variable cost, from total sales, from Sv, that is total cost, we get contribution. So this is what? This is the contribution. This is the contribution. Okay. So this much contribution the company is earning by selling OS units. Now contribution minus fixed cost is profit. Vn is contribution and Mn is fixed cost, because this length is equal to this length. Vn is the total contribution and Mn is total fixed cost. So what remains? Remains Vm, isn't it? If we deduct Mn, that is fixed cost, from Nv, that is the contribution, we get what? We get profit. So Vm is the amount of profit. This is the amount of profit. On the other hand, suppose the producer is actually selling here. Actually he's selling say R units. Say R units. Okay. Now suppose this point is T. This point is say O, and this point is say K. Okay. Now you can see point T lies on total cost curve instead of being lying on total sales curve. It lies on total cost curve, and point C lies on sales. That means a total cost curve lies above the total sales line. Okay, this is total cost line and this is total sales line. So this part is the loss. This much loss the producer is incurring by producing OR units. Okay. Now if we apply the concept of sales minus variable cost, what we will see that this much is sales, that is CR is the sales and TR is the total cost and KR is the variable cost. Now you can see sales, this is sales minus variable cost remains this much. This is the contribution. Now this contribution cannot recover the fixed cost. That is why this much loss is being incurred by the company or the producer, as the case may be. Okay? Have you understood what I have said? Once again, please listen to my lecture instead of looking at the papers. Now I am going to summarize what I have discussed today, in this video. Firstly, marginal costing is a technique or tool of costing used to make many management decisions. Management decisions include decision to launch a new product. Launching a new product needs new machinery, that means new investment, or ceasing to produce a product which is not that much profitable related to other products which are more profitable, and increasing the production of the more profitable product, or such a decision as to whether to make or buy. This is called make or buy decision. That means the company or the manufacturer can manufacture certain spare part in his facilities, using his own facilities, or he or she can purchase the spare part from the market to incorporate in his or her own product. This is called make or buy decision. This make or buy decision also depends on certain interpretations drawn by using marginal costing technique. Then there can be a business opportunity for a firm to enter in a foreign market. Entering a foreign market is not a very easy affair for a company, and the decision whether to enter a foreign market is taken by analyzing many things, many data, using and many interpretations by using marginal costing or variable costing technique. There is a word used in economics that is called dumping of products. Dumping of products means when a producer sees that the domestic market is saturated, he has no other ways to sell his finished products in the domestic market, then the producer can think of selling the products at a lower price in a foreign market. This is called dumping, and these sales are made only at the marginal cost level. That means the prices of these products are fixed at the marginal cost, because all the fixed overhead costs are being recovered or are being expensed annually in the domestic profit and loss account and balance sheet. Okay. Now, the most important, singularly important tool of marginal costing is break-even analysis. And in the break-even analysis, we have seen how a firm reaches break-even in terms of units or in terms of sales, how the profit is calculated by deducting variable cost from sales to get contribution, and then deducting the total fixed cost from contribution to arrive at profit. We have learned what is margin of safety, what is angle of incidence, more the angle of incidence, more is the profit earning capacity of the producer. Less the angle of incidence, less is the profit earning capacity of the producer. And the angle of incidence is formed by the intersection of total sales line and total cost line. The right hand part of the break-even point is called the profit zone, because as the producer moves further right, that means as the producer produces and sells more commodities, he starts earning profit, and as sales increases, his profit also increases. On the other hand, at the left hand side of the break-even point, it is the zone is known as loss zone. That means if the producer even sells one unit less than the break-even unit, he starts incurring loss. And more amount he sacrifices in terms of sales, that means he cannot sell in the market. His sales is coming down. His loss also becomes bigger and bigger as the angle of incidence, the gap between the total sales line and total cost line becomes bigger and bigger. And remember, at the left hand side of the break-even point, the total cost line lies above the total sales line, and on the right hand side of the break-even point, the total sales line lies above the total cost line. Okay, so enough for this video. I hope you have enjoyed this video. I would like to have queries. Please develop queries in your mind. I would like to have comments by you. These queries and comments will enrich me, and myself on behalf of DM tutorial will be able to provide videos with more better qualities, and also our teaching process, the online teaching process will improve. Okay, thank you for watching this video. Goodbye.